$1 trillion US. That's the amount of money which needs to go in for the infrastructure development during the 12th five-year plan, going by the estimate of the Planning Commission. Who is going to fund this? Unlike Western countries, in India, the primary responsibility to develop infrastructure rests with the commercial banks, because long-term funds, their involvement in infrastructure segment is relatively insignificant. But will banks be able to fulfill this? If we take a close look at the exposure of banks towards infrastructure, we can see that a significant portion of the bank money which has already gone to infrastructure projects have become stressed, which means they are either being recast or become NPAs. The major reasons for this happening is the increasing delays in giving approvals for critical projects, which in turn impacts their cash flows and their ability to repay money to banks. Because of this, about 50,000 crores of loans are being recast under the so-called CDR mechanism, and a lot more outside the CDR cell. And there are also cases of loans becoming bad, NPAs. So the critical part is that how soon the approval process can be made smoothen, the approval process can be made speedier, so that projects can get back to track and start repaying their banks. The fact remains that at this stage, infrastructure is the biggest stress area in the books of Indian banks, creating a lot of pain, a lot of stress, which might even require the intervention of the Reserve Bank of India to give something like a special dispensation for banks to come off the peak of the restructuring burden.